I was going to Europe for a family holiday at the end of the year. I was absolutely exhausted by that point, and there was no way I was going to be doing any work during that period. So I suggested that, well, if we could do it by this period, we could get it done this year, but otherwise let's talk again next year. And after some consideration, they decided they could. We've learned through this process, we actually need an exit strategy and a plan to go around that. We entered into due diligence and got reasonably far down the due diligence process before there were some things that came out that we hadn't really realised would be expected in due diligence and we weren't comfortable with. So, after some negotiation, we actually withdrew from that process. There's a lot of luck in business, there absolutely is, but successful business is anchored in intent.
I have founders approach me all of the time for help for their business. It might be to raise money, it might be to get back into a growth mode. And so the first question that I have for founders always is,
they wanted a good, clean business, good capital discipline. For us, good financial discipline, budgets are always a constraint, right? So it created that discipline around product management, it created the discipline around our go-to-market and market expansion strategy. So it was helpful for us as well. And, ultimately when we came to exit, we were looking for
Today's guest is Kelly Brown. She took over the role of general manager of a part family business of a company called Triquestra. She ran that business for 18 years, which was a really fascinating journey as she was very intentioned about getting clear on what the shareholders' expectations were. There was a missed opportunity to sell the business around about 14, 15 years in, a lot of learnings that were taken away from that. And then there was a really successful exit that they had to a very, very large Canadian listed company. Some fascinating insights on strategy, on culture, on planning, and how to run a growing business in a market that is continually changing around you. I hope you enjoy the conversation. Kelly does some great sharing. Today on the show, we have Kelly Brown. Kelly, welcome to the show.
Thank you. It's great to be here.
Thanks for coming in. Hey, so 18 years with one company, 18 years with Triquestra. How did you keep it fresh?
Yeah, 18 years. It's a really long time. And when I reflect back on that, I sort of think the same. But I think I feel like, we grew Triquestra from early stage right through to exit, grew the business, huge amount of market change and technology change in that period. And so for me, it really felt two things. It really felt like maybe 4 careers in one, just based on the needs of the market and the business over that 18 years. And I think also just creating and keeping that culture and surrounding myself with people who we're really passionate about a vision, about our strategy, and about remaining curious and innovative and excited about what we were doing.
We'll unpack the exit as we go, but you ultimately left the building, so to speak, around about a year ago.
Yes.
And so if I think about the duration and the tectonic shifts that were going on in the background from a technology standpoint,
yes.
We covered off the birth of cloud computing. That was really kind of 2012, 2014 kind of thing that people started to wake up to that reality.
Yes.
So that came about and impacted the business.
Yes.
We had the AI revolution that was, started when I started Ambit 2017, but really accelerated in 2022.
Yes.
And then there was the kind of shift in, there was COVID in the middle of that. And so you talk about 4 careers, but there was also some massive things that were going on from a macro environmental perspective.
Absolutely.
And so the business itself wouldn't have been the same, but also the strategy had to change. What were some key things, some key kind of changes and some pivots or some inflection points that you had over that duration?
Yeah, that's right. That's 100% right. And as you say, there were those key pivots or key inflection points around technology. And I think, right from the beginning of the 18 years, technology was moving fast, but that just continued to increase. And now we're at, such a rapid pace of technology change. So there was always that to stay across and to keep things fresh. And then, of course, there were our customers, our market, and what was happening in retail. When I started at TQ in 2005, it was very much it was really, e-commerce was such a small part, and it was very much considered a separate channel. And also, at that point, really, there was a lot of discussion around what the threat of e-commerce was to physical retail rather than about, the whole unified customer experience and all of those channels working together. So there were massive shifts in consumer behaviour as well over that period. So when you marry up the enormous change in consumer behaviour, the enormous change in technology, and the pace that just kept increasing of that, that kept it really fresh for me and for the team, and also meant that we really had to stay on top of our strategy. And I'm a big proponent of, there's a lot of luck in business. There absolutely is, but successful business, is anchored in intent. So strategy, governance, planning as well. So, being able to adapt, to understand those macro trends and be able to adapt was really key throughout that. Yeah, and exciting and fun, heaps of fun.
Yes, it's got to be right. We spend so much of our waking lives doing business and, in the business of business that it needs to be fun. But let's talk about the things that you enabled yourself to keep up to date with what was going on from a macro technology change, but also customer demands. What were the habits that you had that enabled you to keep abreast of things and make sure that you kept Triquestra out at the leading edge of the competitive landscape?
Well, I think that's really the advantage of certainly medium-sized business, small and medium-sized business, is that ability to stay close to customers and to hear it directly. So for me and my team, we were talking to our customers constantly. We were involved. We had a global network of partners. We were very focused on partnerships and relationships, and so remaining involved in the retail sector, attending events, reading webinars, just all of the things that you do to stay, and probably the main thing, just staying really passionate and curious about what our customers needed and what they needed from us, what they needed from the market, and what was going on for them.
So you joined Triquestra. Triquestra is a family-founded business. Let's go back to the very start. So what was the origin story of Triquestra?
Yeah, so originally not founded, as family. It was founded by three exceptional people. I've read quite a lot of research actually that says 3 co-founders is the perfect mix.
It is.
So it was started by Miles Bland and Alex Kuznetsov and Lynn Walker, who is my mum. So they started off, actually they co-founded initially ALM Systems back in 1995 and then went on to co-found Triquestra in 2000. So they were the co-founders, and they really did the startup stage. And I joined in 2005 2005.
What was the scale of the business when you joined, and what was then some kind of steps along the journey beyond that point?
Yeah, so a little bit of the backstory. So, I think 3 exceptional co-founders, and they, as I said, they started the business, and the point that they got me involved, I think the foundations of their success as a partnership can be put down to 3 things. They had a shared vision about what they wanted to do. They had very distinct skills from each other, and they also had a high respect for each other, and created a culture, a no-ego culture, which became very important in TQ's long-term success. So the point that I joined, they'd been through that hard startup phase. They'd built this incredible product. They'd seen a market opportunity at that stage. Retail were still all using DOS-based systems, and we were starting to see, all of the ERPs really start to push into this space. The Microsofts and the Oracles and SAPs starting to push down to the mid-market, and Microsoft pushing up from small business into mid-market. And they saw a real opportunity because those ERPs, while they were really great at the broad solutions, really weren't great at that more agile end of a retail store environment. So while they were doing the back end, so they saw the opportunity to build a system for retail stores. So they did the startup phase, and it got to 2005, and at that point recognised that it was really an inflection point for the business. They had achieved product market fit. They had customers, they had revenue, they'd started a bit of international expansion. And then two things happened. Lynn decided she wanted to step back a bit, very much the entrepreneur, high energy, startup kind of culture person. And Miles wanted to very much move out. And, in startup, you wear every hat in the business, every hat imaginable. And he really wanted to, as the business grew and got traction, his passion lay in innovation and designing and building amazing software products. And really, as the business grew, that's where it needed him to be as well. So at that point, they recognised two things. They wanted to transition as co-founders into different roles, and the business needed a different skill set to take them to the next stage, which was around growth, structuring, that sort of thing.
Yes.
I sort of became a natural choice. So my background, I'd done 10 years in corporate at that stage, had proven myself as a reasonably capable digital product marketer and early management and leadership potential. And of course, quite deep founder empathy with my mum being one of the co-founders.
Yes.
So that's how that came about.
So they swapped one walker out for another who was actually a Brown at that stage, or about
correct.
to become a Brown?
I was just about to become a Brown, but yes,
okay.
They did.
Yep. Nepotism is one of those things that from the outside, if you're not a part of it, is really annoying, but you're on the inside in this instance. How did they make sure that they had independence in their decision-making when they were going through the hiring process of you?
Yeah, really great question. And I think governance played a key role in that. Now, governance has always been something that, again, as I said, has been a key part of Triquestra's success. And, governance evolves over the life, obviously, of an organisation, and a growing organisation like Triquestra. It started off, and in fact, talking nepotism, Ray Walker, who was my dad, was the first chair of Triquestra. And so he, again, advised the business on this. But key to that governance was, and to make the point around that, when I say he was the chair, he was the one director of the business, and but the governance component of that was really structuring right from the outset so that everyone understood their role and their different hats. So yes, co-founders, shareholders, but of course at the time they were also directors and employees. And so it was really, there was quite a big exercise around understanding, well, firstly, the recognition of what the business needed and what each of the co-founders wanted for themselves, and then the definition of those different roles. And then it became very clear what the role of the new general manager at that point had to be, and therefore who was a fit for that. And I think that that managed a lot of issues, tight governance around that all the time. And again, the culture of trusting in the right people, managing performance, always managing performance, holding people to account, but keeping those hats separate, I guess, or keeping those roles separate.
Yeah, I love this conversation. I have founders approach me all of the time for help for their business. It might be to raise money. It might be to get back into a growth mode again. And so the first question that I have for founders always is, so what do you want from this business? And they tend to wander off into, well, I'd like to expand in this new market over here. I'd like to modernize the platform over there. I'd like to bolster the leadership team over here. So they talk about the business at the outset.
Yes.
And I go, actually, I need to know what you want as the owner and the founder of the company.
Yes.
And so what I've now understood very clearly is that most people get kind of buried in the mechanics of the business.
Yes.
And it might be strategic thinking,
yes.
but they're thinking about the business first rather than the shareholders first.
Yes.
Because what I now know is that strategy starts from going, what are the shareholders' intentions for the business?
Yes.
Because investing for growth is very different from having a profit-making machine, is very different from taking external investment in the company and all of the things that entails.
Yes.
And I'll come back to bootstrapping in a second. So you start with what the shareholders' intentions are, then you establish what a vision for the company is, what's possible for where we're going, and then you move into going, what's our strategic motion that will enable us to get there, and then you can do the planning on a quarter by quarter basis. But I see people all of the time, they jump straight into quarter by quarter planning. What are our action points? What's our 100-day sprint that we're going to get there without having clarity on what it is that the shareholders want? So it's a really helpful thing that they had that mechanism and the awareness to be able to do that in a day where strategy was not that well formed back in 2005.
Yes.
So well done. Kudos to the team.
Yes.
The other thing is that you mentioned the co-founding team of 3 and that being an optimal mix.
Yes.
I haven't talked about this on the show. I have the same view. And so ideally you want someone who's got strong sales chops about them, someone who has a strong product mentality and the ability to package and think in product offerings, positioning. They might be technical product or they could be marketing product, but they just really, really clearly understand product, kind of a Steve Jobs kind of, hat mentality. And the last is someone with really strong engineering chops.
Yes.
And so then that gives a really natural separation between responsibilities of those people.
Yes.
And one of the things that you talked about was having clarity of responsibilities and alignment. That to me is what I call very crudely sticking to your lane.
Yes.
Because once you know what it is that you're targeted with doing and you've got some measures around that role, then you can get yourself into the rhythm of achieving those things. And people don't meddle in each other's areas of responsibility.
Yes,
Establish a good mechanism for conversation around it, which might be a monthly operating rhythm. It could be a weekly rhythm. But just that's the time to have Q&A and just leave people to kind of get on with their job. So is that kind of how the business of Triquestra was run in those early days when you came on as the external GM?
Yeah, that's exactly how it was from the outset, actually.
So in terms of those board meetings, were you a member of the board at the outset or did you report to the board?
I reported to the board for a number of years. And as I say, that evolved over time. So our early board meetings when I first started were breakfast Wednesday mornings at 8 with Miles, who was the technical director, and Ray, who was the external director, my dad. And so those were weekly meetings over breakfast, and that carried on for a couple of years. As the business grew, again, and that was appropriate for the business at that stage, and we got all of the strategy and oversight that we needed in that forum, and that worked really well. As the business grew, got bigger, got more complex, we implemented a more structured board format. And then, of course, as it got bigger again, I was appointed a director after a period of having, performed as CEO. And we also brought in external directors as well at that point.
Yes. I love the intention that was quite clear in moving through those stages. I think a lot about age and stage of business.
Yes.
And making sure that the mechanisms that you have to run that enterprise are appropriate for that age and stage.
Correct.
Because we can either undercook it, and the detriment is that we don't have independence of decision making, we don't have effective risk assessment, and we don't have enough contribution and challenging of the thinking. So that's the undercooking, not having the board at the right time.
Yes.
The alternative that I see quite a lot, and I've got a segue question from here, is that the board structure becomes overcomplicated for what the business needs at that stage. And I've seen companies where there's less employees than there is board members. And I'm like, what the hell are you doing? Like, this is just way, way, way too complex for what it is that you're trying to solve in the business. Like at that point in time, you're just trying to be scrappy and get customers, right? You've got half a dozen staff, and there might be that's the wrong. It was about 4 staff, and there was 5 people on the board.
Yes.
I'm like, this is just crazy. Like, we should have like one external advisor having a conversation on a week-to-week basis with the CEO to make sure that they're actually winning customers and they're clear about what the right path to get that product market fit is. And you're overcooking these conversations. So, that was changed afterwards. But you mentioned that the company was bootstrapped, and that was an intentional decision. Why was that such an important part of the founding of Triquestra?
In the founding days, it was really around, they had a vision, and really the intent was to build a good, sustainable business that gave the co-founders, the owners, the flexibility they wanted, the ability to do what they wanted in terms of, building great software, solving big problems, having flexibility, and being around for the long term. So the intention was to build with profit, to be part of, to help grow the economy as a New Zealand business, to provide a great place for people to work, and to build an asset over time. So we were able to achieve, steady organic growth, staying close to customers, that was really the intention, and we didn't need to bring in external capital, for that purpose.
Yeah. It's funny, over the times that I've been investing in early stage and startup businesses, which is just coming up 25 years now, there's been trends and cycles that have gone on in the market.
Yes.
And the most reckless one, I think, was the 2015 till about 2022, where the mantra was essentially grow at all costs.
Yes. Yeah.
And so let's just keep throwing money at that problem, and let's make sure this business continues to lose money.
Yes.
And as long as we're acquiring customers, then happy days.
Yes.
That creates false economics, because the economic model becomes unsupportable. And so in 2022, 2023, the call was continued to be, let's understand how we can move this business to a cash flow positive position. And now that's actually gone, we need to move this business into profitability.
Yes.
And so that's had like a massive shift on how these companies are run, the types of resource that are in there, and the disciplines, which I think is actually a good thing, because grow at all costs is a mentality when it works if everything is rising. A rising tide lifts all boats. But if you're in an environment where we've got craziness from tariffs that are going on, we've got certain parts of the global economy are really suffering and others are going through growth. We've got pandemics that are just kind of being recovered from still, weird government debt everywhere. It's a really unusual operating environment. So I'm pleased that was the really clear intent. Did you ever question it?
We often questioned it. We often looked at it. And as I said, part of our strategy was always to think about, okay, what's happening out there? What are our aspirations? What's happening in the market? Therefore, do we need to do things differently? But, as I say, our intention, and it's interesting what you say, because it wasn't really glamorous to bootstrap a business for quite a period of time. And part of it, I couldn't understand the big $1 billion valuations. I actually couldn't understand it, like why they happened and what was underpinning that. I spent a lot of time scratching my head about that. But absolutely, we reviewed it, we thought about it. And ultimately, we got to be the kind of business that the shareholders wanted. They wanted a good, clean business, good capital discipline. For us, good financial discipline meant investing in the right things. It created those, budgets are always a constraint, right? So it created that discipline around product management. It created the discipline around our market, our go-to-market and market expansion strategy. So, it was helpful for us as well.
Yeah.
And, ultimately when we came to exit, we were looking for a values-aligned partner in that space too.
Yes. Go-to-market is something that's near and dear to your heart. And what the research team has dug up is that you joined the company with about 40% of the revenue coming from overseas, and then the remainder from New Zealand.
Yes.
And your intention was to kind of markedly push the international market. So talk us through some of those early motions that you had around go-to-market and what changed over the duration of the time that you were involved with Triquestra. 18 years is a long time, right? So. Yeah,
well, I think our offshore play was always a product, a software product strategy. And then our New Zealand, Australia market was much more direct, but initially had a much higher services component. So, some of the evolutions we went through in terms of strategy to meet that market demand is that, over a period we were, quite focused. We continued to build a very strong core product and offered, services to customise that product around the outset. That got to a point, both from a business perspective for us, because, services, custom software is a lot more expensive to maintain going forward and creates a lot less flexibility. And in a market like retail that was evolving quickly, it needed to be flexible. So we got to a point where we started to pull back from the services and we re-looked at our product strategy and went all in on product, essentially. So because we were selling in Australia, New Zealand, in particular to medium to large retailers, there was always going to be a services component around implementation, configuration, some degree of integration, but we essentially cut the custom software development we were doing on top of the product right back and stopped doing that, and instead got really disciplined around building product. we had quite a bit of pushback on that to start with, because customers who wanted exactly what they wanted. But ultimately, we were able to demonstrate the value of using a standard product to these retailers, not just from a cost perspective, but also from the fact that actually looking at where the custom software had stayed put for an investment that you really want to have for 10 to 15 years, we were able to show how the core product had evolved over that period. So we moved much more to a software product model in Australia and New Zealand, which essentially mirrored what we were doing offshore. So, that kind of fit.
Yeah, that makes sense. So within the software space, most people start with direct to customer sales if they're B2B sales, and then they look to the international market to expand. Yes. And the answer is nearly always we need to find partners.
Yes.
And it's really hard to get partnerships
it's
right.
so hard.
Yeah. So what did you do to make those work? How did you select the right partners and how did you set each other up for success?
Well, we had a lot of missteps, of course. That's how it goes. But I think recognising very early that we wanted, or what would be successful for us, was a very small number of very committed partners. And, I talk about partnership quite a lot, and partnership's a concept which is quite dear to my heart because I think in business particularly we talk about partnerships sometimes a bit loosely, and, partnership really is about having a shared vision and a shared goal, having complementary skills and something that each party bring, and the desire to work together to make that happen. So, what we figured out early is that we needed partners for whom our business was a very key part of their business, and their business was, in some way, very reliant on sales of our product. Of course, we had lots of approaches from, and we approached lots of organisations who our software would be sat on the shelf and be a nice to have for their offering. It might be complementary. They might be able to say, we've got this over here. But particularly for a product like ours, we really wanted something that would lead a sale for our resellers. So we put a lot of effort into finding who they were. And then we put a lot of time and investment into them, making sure the product was right for their market, making sure they were well trained, well supported, assisting them with sales, lead generation, helping them with closing sales, helping them with their go-to-market essentially too.
Yeah. That's involved, and it's not a surprise to hear that. With the Ambit business, we had a dual strategy, and it was intentioned because the plan was to start direct in this market and then get a beachhead in an international market and then bring partners in alongside that and then pass those opportunities over time to the partners. And it was successful for us in New Zealand, but it took a long time to get it right in Australia, and we never really got it right beyond that market, to be fair. My takeaway from the experience that I had, and it was really getting burnt by getting it wrong on a number of occasions, is that there is the stated strategic intent from the partner, and then there's the one that they're actually delivering in the marketplace.
Yes.
And so, and sometimes they were the same thing. Yes. Often they were slightly different. Did you experience that at all, where people were kind of saying, yes, we're really keen to do this? Was that one of those missteps?
Oh, absolutely. Yeah. And I think it's a really good point. And also your point illustrates the point around needing to be quite an important component of their business. So if they're using you as the sprat to catch the mackerel, they're focused on selling the mackerel, not the sprat. So, being quite a key part. But also, yes, of course, but often that's not what people intend, but, business evolves and that's what happens. So, I think paying attention to those partnerships, again, around clarity of expectations, around strategy, goaling, making sure you've got those agreements around what we're both expecting from this partnership, and oversight, governance, checking, are we achieving what we said we would? If not, why not? Can it be remedied? And if not, do we exit this partner? So I'm quite a big proponent of fail fast, the old fail fast saying, because my view is that if you're not failing, you're really not pushing the boundaries enough. But the problem becomes when you hang in there, when you can see that there's a problem, or you're ignoring the problem, or whatever it is, and you're letting something continue, because that takes your opportunity away from moving on to something again that might fail, or the opportunity to actually hit the thing that's not going to. So,
yeah. I've heard you say that before in relation to people.
Right.
So hire slowly, fail quickly
Yes.
is one of the mantras that I think that you had around people, not in a negative sense, but rather just being, if the person's not performing, if the alignment's not there, then it's probably not going to change, is what I made that mean. Did I have the right end of the stick there?
The mantra there is really, people are the most important thing that you have in a business. So you have to spend the time making sure, and you know this, Josh, of course, but making sure you've got the right people. But again, you sometimes get it wrong. And, you know, I think that it's really important to manage performance and deal with that in a way that identifies, firstly, being clear what's expected, two, recognising or having clarity for that person on what's expected of them, what they need to achieve, monitoring to make sure it is achieved, and if it's not, giving them an opportunity to improve and to get back to that point. But, I think it's really important in a high-performing culture to manage performance, not only for the impact that the poor performance has on the business, but high performers don't want to work with poor performers, and they don't want to work with leaders that allows it to happen, essentially. So, I think that's another key part of people strategy. And usually if someone's not performing in your business, it's as bad for them as it is for the business.
100%.
So supporting them to find something that they can have purpose around and they can perform in is, I think, the best thing everyone can do.
Yeah, I think that's a really evolved way to look at it, and I agree. Most people don't want to be doing a job that they're not performing in. They don't want to be doing a bad job of something.
Yep.
And so a failure of an individual, of a hire, is almost as much the responsibility of the person that hired that person as it is the individual. And often what I've seen with people who have a blip in their resume, sometimes you find someone who has oversold themselves continually and they're trying to position themselves for jobs that they're just not appropriate to be doing. And that's a bit of a wake-up call moment that they have to have for themselves. Yeah. You mentioned fail quickly. So how do you measure, how do you know when it might be time to think about going either the partnership or an employee that, this just ain't working? How do you know? Thanks for listening, and apologies for the interruption. I wanted to share with you that this show is one that we, the team, collectively pour a lot of effort into. There's resources that are involved. We have producers, promoters, and wonderful guests that share their time with us so that you may learn and possibly, hopefully, make some impact on the world as a result of that learning. The only thing I ask of you is go and check out my website. There's a diagnostic tool on there. There's a free downloadable chapter of my upcoming book, remarkably called 2 Commas. And there is some other fascinating resources that I'm not going to tell you about because you need to go to the website to check them out. So thanks for listening, and please continue enjoying the show.
Oh, I think that's context dependent. Again, you kind of have to be aware of what's involved in, is it skills based? Is it attitude based? Is it strategic intent based? What you have to analyse what the root cause is of what's going wrong. And I think that's true of everything. Okay, firstly, having the measures to make sure we know what success looks like, what good looks like. And if we're not achieving that, really peeling back the onion to say, why not?
Yes. And
then making decisions about how to go from there, on that basis. So I think not an easy one-size-fits-all answer.
Yes. Yeah. I hear you. Yeah. You've talked about culture. You've mentioned the C word a couple of times.
Yes.
And one of the things that you talked about post the deal was being most proud of building the leadership team and the culture of Triquestra.
Yes.
So let's unpack that a little bit. So what do you do to foster and create a good cultural environment?
Well, I think culture, again, over the lifetime of a growing business, it evolves, it changes. Leaders have to be different at different stages, and culture is different at different stages because in the early days you've got very tight communication, you're very connected to all of the people, and then as the business grows, that all changes. So I think culture is something that changes, evolves naturally anyway, and it's fragile is not the right word, but it's certainly fluid. It's something that you don't set and forget. It's something that you constantly work on. So it's just something that I've always been very clear about. And for me, the components of that, again, come down to strategy and communication. Here's our vision. This is what we're about. At TQ, we would have a monthly all hands meeting that, started with our strategy, with our vision, our purpose, our mission, and key updates both on our plan but on the forward view. So I think a lot of businesses spend an inordinate amount of time looking backwards rather than looking forward. So we always kept that purpose and vision up front. We made sure people understood it, and we communicated about what we were doing and also about how each individual's role contributed to that. So we made people feel, I hope, had feedback that we made people feel included, and that we made them feel passionate and inspired about why we were there for, what our purpose was, and what we were achieving, and made it easy for them to understand how they contributed. So that generally gets people excited. Alongside all of the usual futsal tables and lunches and things like that.
Yes.
And I think a genuine respect for people and an understanding, and again recognising what people need from work in their life. We had high standards, high expectations of people, and enabling them to balance that with what they wanted from life as well.
Yeah. It used to surprise me, no longer anymore, the amount of people that are unable to articulate what the company's strategy is that they're working for. And I've got some data around this actually. So in the USA, which is where this sort of stuff is measured, 75% of middle managers were unable to get half of the company's strategy correct based upon answering a multi-choice questionnaire.
Wow.
So I'll play that back again. 75% of middle managers were unable to get half of the strategy right based upon a multi-choice questionnaire. And so it's actually really refreshing and quite unusual to have that regularity of rhythm of communicating what the strategy is, where we're going, how the performance is going, and also looking ahead, because you're right. Most people talk about P&L, outstanding tickets that might have been sold in a customer success environment, maybe leads that are coming through the door, but that becomes that moves into a leading metric. And so it's a really refreshing thing to hear that you have that that willingness and awareness to be able to communicate regularly with the team about where it is that we're going as a business.
And I think that probably the other component about that, I think a lot of businesses make strategy too complex.
Yeah.
And put it in a 30-page document, that doesn't see the light of day. So to me, strategy should be simple. Everyone in the organisation should be able to understand it. We weren't perfect on communicating strategy always, but that was always the regularity of it, I think, was important, because it's not top of mind for everyone all the time, every person in your organisation. And of course, we still did look backwards. We looked at backwards, but again, we kept that culture of no blame. We looked at performance retrospectively as a way to learn, not as a way to, point fingers or anything like that. It was always about, okay, what can we learn from what hasn't gone well? And just as importantly, what can we learn from what has gone well? And what do we take forward from that?
So you mentioned that it evolved over time, what you shared with the team from a strategy standpoint. What were the key, the most important aspects of what you were sharing with the team as that became an evolved mechanism for you at the All Hands? What were the key kind of bits of information that you shared with them?
Well, I think as we got bigger, everybody's roles are quite different. So it's, you can kind of get stuck in what's happening in your sphere. So we made it very much a sort of around the houses, so updated on what was happening in different parts of the business and what different roles were working on. And we also gave people the opportunity to come and ask the questions that they wanted to come. So the number one thing we always reflected on was customer relationships, how we were performing against our targets.
How did you measure customer relationships?
Oh, it was quite rudimentary actually. We were, as a medium-sized business, very, working closely with our customers. So we relied on kind of qualitative, discussions and, things like the number of support calls outstanding, the project we were doing. So we didn't actually survey very often. That's something, that I would recommend doing. Survey, we didn't do a lot of that, but we did talk to our customers a lot.
Yes. Yeah, got it. Okay. And so in a certain inflection point of the business, at a certain point, you were approached to consider a M&A conversation. So what duration of how long had you been with the business that happened?
Oh, I must have been with the business about 13 years at that point.
Okay, great. So we're kind of 2018, just pre-COVID.
Yeah.
And so talk us through that journey. What happened? Because ultimately it didn't result in a sale at that stage. So this was the non-starting M&A part of the story.
Yes. So we had an offer, an opportunistic offer, that looked good from a shareholder value perspective. The shareholders felt like, yep, this might be the right time to sell. So we did enter into a process. We entered into due diligence and got reasonably far down the due diligence process before there were some things that came out that we hadn't really realised would be expected in due diligence and we weren't comfortable with. So, after some negotiation, we actually withdrew from that process. So we didn't complete at that point. That really gave us the opportunity, I think. It was very disappointing, obviously. I think deciding to exit is, particularly for the co-founders. And by that stage, there were myself and two of our lead team had also come in as shareholders. We'd bought into the company. And so it's an emotional process when you decide to exit. There's a lot goes into that. A lot of work, a huge amount of work goes into the due diligence process. It was messy. You take your eye off the business, as you know, you take your eye off operations, and you're really wanting this to work. So it wasn't successful. We withdrew, but in true learning form of reflecting on, okay, this hasn't succeeded, why not? We were able to look at it and say, actually, we've learned through this process and we need a strategy. We actually need an exit strategy and a plan to go around that.
So you started to think in a structured sense about what an exit strategy could look like. So talk us through the conversations and the thinking that you put into that.
Well, again, I think the process around that was, from a strategy perspective, keep it simple, but answer the questions: why would we want to exit? What would we want to achieve? And therefore, when would we want to do this? And who would we want to sell to? Were essentially was the strategy. So we made some decisions around that. We got pretty clear on that. And then, of course, COVID hit not long after that. And so that was like, for most businesses, a very intense and busy time. We had the opportunity to grow the business through that period while, because initially it was pretty frightening when all of the retail stores started closing. And of course, then there was this massive pivot from retailers to e-com and omnichannel in particular, which really, was really our sweet spot. And it really started to highlight, because a lot of retailers had been doing, had been offering omnichannel, but in a way that was very disjointed behind the scenes, bad impacts on customer experience, costly for the retailer, that sort of thing. So we went into a period of a lot of focus on the business really, and didn't, it wasn't the right time at that point. So then end of 2022, we again started thinking about, okay, right, well, this is our strategy. And we re-looked at it at that point. So 2018 opportunity was around, backed away from the opportunity. You went and formed a intentioned exit strategy. So why, who, quantum and timeframe were the key questions that you asked yourselves. I do really like those questions. Yes.
And did you then also go about making any changes to the business to kind of make it more marketable or more attractive to a potential acquirer?
Yes, so certainly we understood, and that was again, one of the learnings that we got from that process was, we possibly were leaving some value on the table. So we had the opportunity to look at some things, just some fundamental things around, the thing is, we ran a very clean business from the outset. As I said, that was something we wanted to do. We wanted to, have no surprises in our business. It was, we had clear roles for founders and shareholders and employees, and all of that, but, just some, I guess, some little things around understanding some of the value drivers around recurring revenue, for instance, around making sure that all of our contracts were in place, all of that kind of thing. But, mostly around driving growth, I guess.
Yeah. There's an outweight proportion of value attributed to a high growth business.
Yes.
And so I'll just repeat some words that Greg Young, an M&A advisor that we had on the show probably about a dozen episodes ago, mentioned, and I know this would have been the case of Triquestra, but he said things that interrupt deals during DD are unusual things sitting on the P&L.
Yes.
So often founders kind of run some stuff through the business,
yes.
which is a terrible idea.
Yes.
Seems like a good idea at the outset.
Yeah.
The other thing that can disrupt processes is any outstanding legal action, ex-employees, personal grievance, stuff that happens with people that are exiting the building,
yes.
or maybe with customers as well.
Yes.
Those things scare people off really quickly, so you ran a clean business, so that stuff's all good. I talk a lot about the positioning of the asset as well, being really clear on what the narrative of this business is and why, therefore, it would be attractive to someone,
yes.
But who would be the most attractive potential acquirer of that business.
Yeah.
Is that something that you spent some time thinking about and then kind of crafting up that narrative?
Yes, absolutely.
Yeah.
Yes, we did do that.
And so 2022, we'd
yes.
come out of the back end of COVID. Did you manage to kind of get back into that position of being a growth business again between 18 and 22?
Yes.
Great.
Yes, we
okay.
did.
Okay.
So we did. So, it seemed like, okay, now is the right time.
Yes.
I also was thinking, it might be time for a change for me. The shareholders were kind of, ready for an exit. So, it was the right time to do it. We'd done that thinking around, what is our value proposition? And therefore, who would the right buyers be? And and what do we want for the business ongoing and
yes.
for our people?
Yes. And so did you engage an advisor at that point?
We did initially. Yes, we did. Like with most things or everything we did in TQ, one of the principles we had was always to engage experts, as required for growth in all sorts of different facets. We always made sure we had really good lawyers and really good accountants and, independent directors. And so, yes, we engaged an advisor, an investment bank at that stage. And that was part of our plan. So, talked about our strategy, the why, what, we're really clear on that. And part of our plan was to engage an investment banker to find the right buyers for us and to manage that process and to remove some of the distraction of engaging in a process. It's actually probably something we didn't do particularly well. We had a short engagement with that organisation and through that process, mutually determined that we weren't the right fit.
Yeah.
And I think a couple of, that would probably be some advice there is do as much research on your advisor as you do on potential buyers would be my advice there.
Yeah.
So we mutually agreed to part ways. And
had you invested much money? And because investment bankers often ask for a retainer over time, so I'm presuming that you spent some money and there was, of course, the time and the understanding and that sort of thing.
Yeah, we spent some money and we would always expect to spend, some money up front to do that. And again, that was one of the things. Yeah, we could have continued. We absolutely could have continued on the basis that we, had spent some money, but it was clear, to them as well as to us that this wasn't the right fit in terms of, our value proposition, their buyer pool and relationship, which is key. I always think, as we talked about with partnerships, relationship and the ability to work together is a really crucial determinant of a partnership success.
Yes.
You do need to be, I think, very aligned with your advisor when you're going through an exit because of, both the scale of the money involved and the other impacts, the emotional impacts, selling a business that I'd run for 18 years, our co-founders had for much longer than that, and for our people. So it's a really important decision.
Yeah.
So we decided it wasn't working.
Yeah.
And so we disengaged from that.
Extracted yourselves?
From that process, What
did you do then?
Well, it was at that point we I had recognised that, okay, yeah, if we, I had recognised the mistake we made there, which was not enough research, not understanding who the right advisors were for us. So we could have gone back and we evaluated, thought, well, should we go and do that work to find an advisor? And I guess it really occurred then because after the initial foray into the space, I had gotten really focused on starting to understand who the potential buyers were. We had a lot of approaches over the years from a lot of different companies. And so I started to build up relationships with those people over that period. So over a period of 5 years, I'd built up relationships with companies that were really in the sweet spot of buyers for us. And also, I felt like we had a clear strategy. We had a good, we could develop a good plan around it. And so I thought it was something that we could do in-house, ultimately, with that buyer pool. So,
yes.
Yeah, so that's what we did.
Yeah, okay.
Yeah.
So one of those people that had approached you along the journey and the way was Vila.
Mm-hmm.
And so how did you kind of wave the flag to them because they'd approached you and the time wasn't right earlier? So did you pop back up and drop an email to the CEO and go, hey, it's Kelly here, we might be interested in having a conversation? Was it that simple? Or
was that simple.
Yeah, okay.
Yeah, and that was because we had a relationship. So I had, they'd approached us earlier and they Vila have a very long-term approach to their investments, but also to relationships. Their model, which is, decentralised, is very focused on people and highly capable leaders and management teams, and therefore very relationship-based approach. So they weren't in a hurry. I had a relationship and I was able just to actually email and say, hey, we might be ready for a conversation.
Yeah, okay. And talk us through the process. What did it look like beyond that point, and what duration did you put on the deal, DD, that sort of stuff?
And then it was applying those B2B principles of making sure, doing the qualification, is this, do we think this can go ahead? Is there a good fit for us? Is there value for them? Is there a win-win here? Do we have the right points of engagement? So ticked all of those off. And then agreed a plan with them. So we're just very upfront. And, we, from our previous experience, we knew that we didn't want there to be any surprises, which is typically what you want in any B2B sales engagement anyway. So we were very open with anything we thought that they might be interested in upfront before it was asked for, just to make sure that was all factored into the process. And then, created a compelling event. There was a compelling event. I was going to Europe for a family holiday at the end of the year. I was absolutely exhausted by that point, and there was no way I was going to be doing any work during that period. So I sort of suggested that, well, if we could do it by this period, we could get it done this year, but otherwise let's talk again next year. And after some consideration, they decided they could.
Okay. What was the duration between that expression of interest back from them to you and the closing date of the end of the year? How long was that? Was that 3 months, 6 months, 9 months?
It was about 4 months.
Wow, that's quick. Okay.
Yeah.
Cool. Sorry, I jumped in there, so keep going.
Yeah, no, it's good. But, Vila are, they're very experienced. 500
plus acquisitions is what their website says.
Yeah.
It's phenomenal.
Yeah, so they're very
Tell us about Vila.
Integration. So Vila are part of the Constellation Group. They have 6 operating divisions, and they acquire and retain for life vertical or growth-focused vertical software companies. They run a decentralised model, so they centralise, only what minimum amounts. So
like corporate services
corporate
kind of thing.
Services, finance, and really what's required for that business. They typically retain all of the people and allow the business to run as decentralised, separate businesses. So like us, like Triquestra, they're a good values fit, long-term investment focus, organic growth focused, people focused, and vertical software. And they recognised the value of medium-sized businesses like Triquestra that are, to use a McKinsey term, equipped with both stability and agility. So kind of at that size where you can compete with the big guys, but you can be a lot more nimble
Yes. And
So that's them.
quite big, aren't they, as the scale?
Vela,
Yeah.
Constellation, yeah. So as you say, I think it's actually more than 500 acquisitions that they've done, but I think 7th biggest software business in the world by the time you aggregate all of those businesses together. But they're not aggregated together; they are autonomous businesses.
Yes.
But yeah, hugely experienced both in software. Growing software companies and in acquisition. So that made them, able to execute in a fast time.
Yes.
We had a plan, so we were prepared. We had the information that we expected might be needed, all of the fundamentals having been through, the original process that we did back in 2018 and having worked with the investment banker, we had a good idea of what might be required by Vela. So it was fast, but also that wouldn't have been achieved without a clear agreed plan.
Right.
So, it could have drifted on. So we worked with them from the outset, again, to make sure we had a shared goal in terms of the outcome and the date for achieving it. And then we worked on everything that needed to be done at quite a granular level. And developed a critical path, basically, and said this needs to be done by this date, this needs to be done by this date. Yes. And we had checkpoints in place to say we would check in every 2 weeks and say, have we done what we needed to the last 2 weeks? Yes, that's done, tick. So that we kind of knew we were on track. Yeah. Yeah, and we made it.
Yes.
30th of November.
Wow. Okay, wow. I
flew out to Europe on the 14th of December.
Okay,
it was perfect.
2 weeks early. Amazing.
2 weeks early.
Yeah, okay.
Yeah, enough to do the introductions and.
And the letter of intent versus what the closing was, were they the same or was there some deviation, some difference?
It was the same.
Same, yeah, cool. Okay, great. So that denotes the asset that they thought that they'd be buying was the one that they turned up through the due diligence process, which talks to your preparation that had gone on before then.
Absolutely.
Yeah.
The preparation to get ready for due diligence, knowing our value. We did a lot of work to understand what was possible, what was the optimal price we thought we could achieve for this business, and I guess ensuring as much as possible that there weren't surprises.
Yeah.
Yeah. And working with an organisation and people with the right intent, good intent. We had a shared outcome. We had a shared view of what the valuation was. And so it worked well.
Yeah. It's funny. Some people say that they don't like surprises. Others say that they do like surprises. You don't like bad surprises. What you like is good surprises, like an unexpected gift.
Yeah, I didn't expect any good surprises.
Yeah, that's right. Yeah.
Through that process.
So that's a crack M&A team, right? 500 plus acquisitions. This is a really deeply experienced team. And you and your team had been through it once and learned how not to do it. What was it like dealing with people like that this is what they do for a living and there's a team of people that live and breathe M&A? What was that experience
like? It's great.
like?
I love dealing with those people. Yeah, okay. I love dealing with people who have the expertise and know what they're doing.
Professionals.
Yeah, professionals, efficient.
Yes.
Yes. Great learning. Lots of learning through that process, of course. But I'd much rather that than work with someone inexperienced. And, the great thing about in-house teams is they are focused on the outcome. They want the outcome.
Yeah.
They're not trying to prolong anything or they're not overly focused on things that might not matter. There's that classic tale, and this is not, in my experience, certainly, and I should say that's one thing we did. We engaged a really great lawyer to help us through this process in absence of investment banker. Yeah. And he was pretty good at advising a little bit out of the law, but very, very focused on the commercials.
Yeah, deal structure.
And on the outcome. Actually, I think sometimes when you use externals, we're very focused on the legality and the risk.
Yes. And
what you really want is your lawyer to be saying, here's the risk, this is the level of risk, this is the impact, so that you can make a commercial decision. Yeah. And, I think having in-house acquisition teams has everyone a lot more in that mindset than pulling together external teams.
Yes.
And also their time can be managed as well.
Yeah.
A lot better than you can manage external.
Makes sense. I talk about
resources.
The dream team as being a very experienced and preferably in the scale of deal that you're doing, maybe even in the geography that you're doing, M&A lawyer,
Yes.
that they're a critical component.
100%.
And don't use your high street lawyer,
No.
your trust and wills guy.
Yes.
Maybe an M&A advisor, maybe not.
Yes.
In this instance, not. But you've been through the experience of working with someone that wasn't the right fit for you, so you kind of had a sense of what the wrong kind of approach was.
Yes.
Maybe a deal structuring like a finance person, like a CFO or a tax advisory kind of person can be quite helpful, especially with a multi-jurisdictional approach. I was involved in an exit last year, a very large exit, Cami Public. Actually, Alev's coming on the show quite soon. And there was some interesting things around asset versus share sale, and then a description of how the distributions were going to be handled. There was talk of a dividend, and that got everyone's backs up because a dividend in New Zealand attaches tax to it.
Yes.
And so that was an Americanism based upon the firm that was acquiring. That was an appropriate nomenclature for them to use. But in New Zealand, it was completely the wrong approach because it wasn't a dividend. The company was being wound up and it was distributing returns.
Yes.
And so we had to make sure that was kind of represented through all the documentation.
Yes.
Did you have anyone else involved on your side from the deal team that I've missed out?
Yeah, absolutely. So we had an exceptional fractional head of finance, and so the advantage of that is she obviously knew quite a bit of what we needed to provide, but she also knew the business really deeply.
Yes.
So we had her. We had we have always had external accountants and an external tax advisor. Again, he's very experienced in M&A and commercial transactions. And Webb Henderson for our Michael Garchel from Webb Henderson for our M&A lawyer.
Yeah, got it. Okay. I went to the Vela Constellation website before this conversation, and I'm just going to read out some of the things here because it sounds like the experience for you was really positive. And have they bought any other businesses in New Zealand that you're aware of?
Yes, yeah.
Okay.
Yes,
Okay,
absolutely.
cool.
Quite a few in the retail space, vertical, and some agribusiness.
Yes.
Yes. Integration, there's an integration company as well, yes.
Yes. It's funny, often people don't know what constitutes an attractive business.
Yes.
And Constellation put it on their website.
Right. Oh, that's helpful.
So we are pleased to hear from principals or representatives of exceptional businesses that meet the following criteria.
Yes.
So they list them out here. A minimum of $1 million, and this will be Canadian, I presume, or US, in earnings before interest and tax, minimum of $1 million. Consistent earnings and growth, generally EBIT plus revenue growth of 20% per year or more, experienced and committed management, and an offering price that has been determined.
Yes.
So they've got that's not a playbook, but that's a list of things that they will be like, this is the minimum expectation on the website. Yes. And then they talk about good businesses as well. So they go on. So number 1 or number 2 market shareholder in a niche vertical market.
Yes.
Revenues of at least $5 million. So they talk about revenue, not about profit.
Yes.
Hundreds or thousands, not dozens of customers.
Yes.
Unimposing competitors. It's an interesting note. And an offering price that has been determined. So in other words, they're open to hearing from people that want to sell their business, but it's don't turn up with something and say, hey, do you want to buy this? It's, do you want to buy this? And this is kind of what we're hoping to achieve for it.
Yeah, we didn't do that.
You didn't? Okay.
No, we didn't do that. We asked for an offer.
Ah, interesting.
Yeah. Yes.
And they went away, thought about it, did some calculations, came back with a spreadsheet.
Yep.
Yeah.
Well, it didn't come back with a spreadsheet, actually. They just came back with a number.
Right. Okay.
Yes.
Cool. Got it. And I'll finish off with their philosophy, which is a nice way to round out that bit of the conversation. We promise the strictest confidence and would generally respond to inquiries within one business day. Phenomenal turnaround.
Yes.
We will not engage in unfriendly takeovers.
Yes.
So no aggressive stock market-esque kind of takeovers.
Yes.
And we prefer 100% ownership, but we will buy less if vendors wish to continue and participate in the success of their business.
Yes.
So that's like a really clear list of what you should do to your company to get it attractive for an acquirer like Vela Constellation Software.
Yes.
But it's probably not a million miles away what would constitute an attractive business for other acquirers in the software space.
Yeah,
so,
absolutely.
Yeah. So the terms of the deal saw you being able to exit pretty quickly. Is that correct?
That weren't included in the terms, and that again came down to relationships. So I think, as you've kind of alluded to, Vela buy businesses with good management teams in place, and they respect people's aspirations. So one thing that, as part of our plan, that I had done was built a good succession plan. So I was very clear that, this business can run without me. I think I still add value, but, it absolutely can, it's now ready to run without me. And so after 18 years, I absolutely loved that business. I was pretty excited about what Vela would do with that business. But for me, I wanted to step out of my comfort zone at that point, and I wanted to do something new. And first of all, I wanted to have a really good rest.
Good on you. And I'm really pleased to hear that you did that and it was intentioned.
Yes.
Too often I meet founders who have jumped out of one thing and then through the habit of being incredibly busy, they just kind of maintain that pace and that rhythm. And so what I always say to people is that your frame of reference has indelibly shifted, but it doesn't feel like it at this stage because there was this thing that you either had as a critical part of your life, 18 years, and you took it from A to Z along the way, or you birthed this thing and it was like an attachment and an extension of your identity. And so that is now no longer in your life. And so the decision-making frame that you've got has changed indelibly. And so what I see people do too often is they immediately get involved in the next thing. And I have a guest coming up that did that very intention. It actually worked out super well for him. So it's horses for courses.
Of course.
But for a lot of folk, I suggest take that time out to recharge the batteries, get clear on the next phase of life and what that might look like. And so, having that opportunity to kind of decharge, get yourself into the state of relaxation. And did you get bored?
No, everyone said to me, actually, give you 3 months, you'll be bored, you'll be wanting to get back into something. And I was pretty sure that wasn't going to be the case. And no, I didn't. And actually, it really took me 3 months to just actually become a lot more conscious of my thinking. It really did take that long just to wind down. And, and then I just started noticing how much clearer my thinking was. And, so I'm starting to get a little bored now.
Yes, but I think that's a good thing.
But I feel like it's a good thing, and it's a real luxury, and a privilege to be able to do it. And, just to be able to spend some time really having a look. So rather than just defaulting to what I know or to my instincts about, what might be next, is to talk to a lot of people, see what's happening out of there. I've learned so much in the last couple of months since I've been out, having a look around again.
There was one thing I just wanted to jump back and pick up on because my experience is that most people don't do this well.
Yes.
And so you mentioned succession.
Yes.
And so what was your approach to succession and what were the things that you think you did well and maybe if there were any missteps that you made as well?
Well, I think the first thing is absolutely, again, going back to that point about putting ego out of it and being really clear about roles and being clear about structure, organisational design, those things that are really needed. And then, defining my role, looking at talent. We kept a close eye on talent within the business, both current performance and potential. That's something the lead team and I just always did. So, I did that across my team and just building a really great team, like having really great people there. And knowing that, someone could step into that role.
Yeah, got it. So you promoted from within?
Yes.
Yeah, got it.
But it wasn't my decision, actually. My my replacement, my successor, I guess you'd say. Obviously we weren't the owners by then, so it wasn't, but it was certainly my recommendation. Yeah, got it. And Greg Henlin is the CEO there now.
Yes.
He is awesome.
Yes, cool, great. You mentioned 2 words that I use as a part of a really simple process to identify people across the business. It is literally a quadrant with performance and potential. And so performance is how well have they gone from a very, very objective review perspective. So if they continue to be in the green or the exceptional overperforming category over a period of at least 6 months, but preferably a whole year.
Yes.
And then they'll be high in performance. And potential is the growth that they've had over time in the business. So if someone someone has the trajectory, which has been like this, and they've moved through 3 roles over 3 years, for example, then the likelihood is they're going to continue on that path. Whereas if someone stayed at the same level for a period of 3 years, then they may not necessarily have the potential. And the upper right quadrant was the beautiful place to be, a la Gartner, is the future leaders of the business. And so high performance, high potential. It sounds obvious, but I don't think a lot of people have the pause to think about it and actually reflect upon where people sit across the organisation. And if you're bottom left, then why are they in the team? Back to the point that you made earlier, Kelly, about high performers appreciate it if you go through a process of either elevating people's poor performance or escalating them out of the organisation. They appreciate it. And if you want an A team, then that means that you're going to have to occasionally make those decisions.
Yes, absolutely. And I think to that point, as well as with strategy, the talent matrix was something that we looked on a forward basis as well as backwards basis. So potential was about where people have elevated to, but also about where they potentially can go and or want to go, because as well as those top right corners, our business needed the top left ones as well. So the ones that were extremely consistently high performers, but actually didn't have any aspirations to move into different roles. And a business like Triquestra that, is complex, it's broad, that knowledge and consistent performance is actually sometimes great to keep in a role if those people don't have the desire, to move into other roles as well too.
I didn't mention the top left quadrant, which is high performance, but potential, which is either unclear or not necessarily high potential. It's retain and incentivize those people, because we do still want them in the business because they are high performance. But the top right is that future leaders, which is the growth
succession.
into.
Absolutely.
So we're coming up nearly a year out, and so I'm always loath to ask people what next, but that's a reasonable duration to reflect on things. So what's kind of brewing around in your mind for Kelly Brown's next steps?
Probably 2 things is that I've talked a little bit through the podcast around my belief that business success, one of the key components, or 3 of the key components to that, are around strategy, governance and culture. So what I do know is that I want to get more involved in governance. I'm seeking a couple, potentially 2 to 3 board positions. But I also really like getting my hands dirty and getting in amongst a team. So I'm potentially thinking about what I can do from an executive point of view, maybe most likely on a fractional basis, or, so there's a more portfolio approach. Both for my own satisfaction, but also because I believe that as a director, governance is really enhanced by a really good core understanding around what the macro trends in business are. And with the rate that technology and consumer behaviour are evolving, I think that's really helpful for governance. So I haven't figured out that part yet, but certainly the governance roles I'm actively looking for.
Yeah, that makes sense. If someone is watching or listening to this, they'd hit you up on LinkedIn if they wanted to have that conversation with you.
Yes, absolutely.
Great. Kelly Brown on LinkedIn, open to connect requests. Thank you. So I look forward to following the next stage of your journey, Kelly.
Thank you.
And I'm very grateful for you to come on the show and share your experience and your wisdom with all the listeners out there. So thank you.
Thanks for the opportunity, Josh.
Cheers. If you enjoy these episodes, I hope you do. I love filming them, and the guests always say what a great and often cathartic experience it is for them. Then please do like and share. Hit me up on LinkedIn. I'm open to connect requests, and occasionally I get emails from people as well asking me about my experience around certain subjects. So please do like and share and continue to follow the show. I really appreciate your ears.